Hello, and welcome to Let's Talk Tax, the show for growth-minded CPAs and real estate pros in tax. I'm TJ Sponsel. On today's episode, we will overview the last 18 months of the R&D tax credit for CPAs and business owners to understand where the credit was in the summer of 22 compared to where it is today. We will overview the credit, discuss a little bit about the fundamentals of Section 174 versus Section 41. We will also discuss real-world examples of how the credit is supporting innovation across the country and a few myths and frequently asked questions that are common discussion points around our offices. Joining us today for the first time on Let's Talk Tax is my business partner, Kyle Riddle. As you may or may not know, Kyle is a shareholder at McGuire Sponsel and was the official employee number 3 back in 2007. Kyle, welcome to Let's Talk Tax.
Thank you, TJ. Appreciate that. Technically, employee number 1, since you and Dave are actually not employees, technically owners, so I'd count
Fair
myself
enough.
as employee 1.
There you go. Exactly. And you still consider yourself employee number 1, right?
Yes.
So, funny story, Kyle actually started out in cost segregation. And in early 2008, things were going so well on the cost seg front and the R&D front, and I didn't have anybody to work with me on the R&D front. And so Kyle and I took our first road trip up to Detroit, Michigan. We won't name the clients, but it was probably one of the most challenging client situations in the history of the firm, only for them to come back as a client and remain a client for a number of years following. So, we actually celebrated that client with a very good meal at Ruth's Chris in Troy, Michigan, if I remember correctly.
Yeah. March 2008.
So, Kyle, why don't you tell us a little about yourself?
Yeah, Kyle Riddle. Studied engineering at Miami of Ohio. Was hired. Worked in the construction management industry for a few years before I was hired by Dave McGuire to help with cost segregation. Worked in cost segregation for 5 or 6 years, somewhat concurrently to working with the R&D tax credit, and have lived here in Indianapolis for almost 20 years, since 2005, and five kids, wife, lots of sports, and busy career here at McGuire Sponsel.
Well, is that we definitely have changed over the years. So considering you were employee number 1 and now we're almost 100 employees, I know we have a lot to be grateful for, and obviously very successful because of all you've done for the firm, Kyle. You know, Kyle, I think anytime the R&D tax credit comes up in 2024, 174 isn't follow too far behind. Can you kind of give us the overview of what we've been dealt with over the past 14 months with the impact of TCJA and this entire amortization requirement of 174 and how it interplays with 141 and just some of the things that you've seen, you've experienced, you've helped talk our clients through?
Yeah, sure. So let's talk about the research credit, first of all, under Section 41. A credit that's been around for over 40 years and a very beneficial credit, non-refundable income tax credit that helps offset income tax, and it's kind of an incentive to innovate, and has been a very beneficial piece of tax legislation for a long time. Back in December of 2017, when the Tax Cuts and Jobs Act was signed into law, there was this 174 amortization add-on to that TCJA law that really no one ever really thought was going to happen. And there was a 5-year window, didn't apply until 2022. But for those of us reading the fine print of that bill, we realized, man, if this doesn't get fixed, if this doesn't change, it's going to be extremely difficult for taxpayers to handle, because those research expenses previously could all be deducted immediately, expensed immediately. So with the amortization, the amortization that we thought was going to go away before it rolled into place in 2022 has been extremely difficult for clients to deal with, and has run really counterproductive to, I think, the intent of the research credit, and it has put a lot of taxpayers, small and large alike, in a really difficult spot.
Well, and to kind of, in addition to the cash flow stress and the uncertainty, has been the lack of guidance by the IRS. You know, you go back a year ago, and when this was very apparent that it was not going to get corrected for the 22 tax year, you know, McGuire Sponsel, we kind of built a 174 practice on the fly, building on our knowledge and all those years of experience and thousands of projects of the R&D credit. Kind of walk us through in terms of the challenge that we've had, kind of what I would call in the spring of 2023 23 during the 22 return, and then with the guidance that came out in September of 23, and now how we're trying to address clients' concerns given that evolution.
Yeah, even if you go back to 2022, we were still hopeful during that year that there was going to be a fix or reversal of the 174 amortization requirement. And as 22 came and went and there was no fix, we rolled into 2023 having to deal with the 174 amortization requirement. And that's when taxpayers really realized, oh, we're going to have to face this. And it was difficult for us, for CPAs, and for clients because there was very little guidance. You have regulations that were from 1954 that govern 174 and the amortization requirement, and there was not a whole lot of information out there about what is and is not a specified research expenditure under 174. So as we progressed through 23, we were having to deal with that unknown and advising our clients what should be captured under 174 and amortized and what doesn't have to be captured under 174. And as we rolled into September of 2023, the IRS finally, almost 6 years after the TCJA was signed into law, the IRS introduced interim guidance on September 8th, 2023. So not regulations, nothing legally binding, just some interim guidance that taxpayers could use to help determine what should fit into that 174 amortization bucket. So we still don't have regulations. We're 6+ years past the signing of that law, and the IRS is still hanging taxpayers out to dry with some of the unknowns of what should and should not be captured.
Stepping back, I think, everybody, what we were talking a little bit ago when I introduced the idea, they look at 41 and 174 as the same, and they're very different. I mean, they're definitely related, but they're very different. So stepping back is that because I think one of the challenges that we saw last year was that we had clients, many clients, new and previous, that had this position on what qualified research was. And let's just call it was somewhat optimistic, okay? And then suddenly with 174, they suddenly wanted to tone down their R&D expenditures. Kind of walk through the trapdoor that created, that we counsel and advise our clients on that was being established by using that logic.
Yeah, so with 2022 and the amortization requirement, taxpayers were forced to face the 174 amortization, and their knee-jerk reaction was, we don't do research. Mm-hmm. And unfortunately, especially for those taxpayers that have a history of having claimed the research credit under 41, there's historical precedent there that they do have research expenses. And if they have Section 41 research expenses, they also have 174 because all 41 expenses are 174, but not all 174 expenses are 41. So we had a lot of clients trying to run away from the credit, and a lot of clients trying to make the argument that they don't have qualified research expenses, they don't have specified research expenditures under 174. However, there's no way around it. If you have 174 if you're conducting research, you have 174 and you have to address it. So it's one of those unfortunate realities, but especially for those clients that have been claiming the credit under 41, moving forward, it's not a choice. You have to amortize those.
And it's a lot more inclusive. 174 is a lot more inclusive. We were talking about just yesterday with a client, and they have, obviously for the Section 41, you need to have the substantial rights and the economic risk. Well, with 174, you just have to have one. And so it's almost a double whammy, if you will, saying, oh, I don't get the credit and I have to amortize. And it's just that's the biggest challenge, I think, is we've tried to explain this to clients. And, I have a lot of empathy for closely held businesses. We're a closely held business. If we sat there and looked at a big section of our business and said, hey, and the government came and said, you can no longer deduct that would impact how we operate our business, how we manage cash flow, and how we determine future investments. I think let's talk a little bit about a couple of. I know there's many things we want to talk about in this time our time together today. Let's talk about what McGuire Sponsel's been doing with our DC connections through the Main Street Innovation Coalition, because I'm very proud of the fact that we are working with our clients and educate them. I think we did a good job addressing the need and educating our clients and CPAs and helping them understand how it got to this point. But one thing that we didn't stop there. We said, let's try to be part of the solution. So can you kind of walk all of our listeners and our audience through what we've been working on over the past 8 or 9 months?
Yeah, so we have partnered with Main Street Innovation Coalition and DC-based team that has really helped shed some light on the legislative action, both in the House and the Senate, with the hope of a 174 fix. And we got that in the House back in January of this year. The House passed legislation that basically retroactively fixes 174. And we have been very active in communicating those legislative updates to our clients, to our CPAs. Unfortunately, we're facing a little bit of a stall with that act or that bill in the Senate. We're hopeful and trying to just keep our CPA relationships and clients up to date.
Well, we've learned in talking to all of our elected representatives, and just to kind of give the audience background, Kyle and I and a couple others have been very active in dialogue with congressmen and women, senators, trying to educate them across the country. We had a town hall in our Phoenix office with Representative Schweikert back in January to talk about how punitive this is, and it's really alarming just how disconnected DC is from Main Street, and the fact that they don't understand how punitive this is. And really, one thing that we've learned through this process is that Main Street, closely held businesses are deeply impacted and are feeling it. Fortune 500 companies aren't really worried about this as much, and it's sad, because I think if they were, we'd probably have some more movement on this. And that's what a couple of Congress people have told us, is that they're not hearing from the Fortune 500. They're sitting there getting all these calls from closely held businesses, but it's not the big money lobby groups that they're accustomed to. And so you hate to be cynical in this world, but they've left us little to no choice. And you hear the fact that there's so much desire for this, and it's such an easy fix, so to speak, if they just could take the politics out of it, because it's been turned into a political football.
The timing has really hurt. It's hurt the CPA industry that serves small and medium-sized businesses, and it's hurt those taxpayers. And we have clients that have been, have hit effective tax rates of 150%, 200%. Companies that had been claiming the research credit historically to the tune of $75,000, $100,000 annually, that now are owing an additional $500,000, $600,000, $700,000 in tax as a result of the 174 amortization. So it has been very difficult for clients, for taxpayers to deal with.
And we, obviously every seems like every other, I think it's every other Wednesday we have a status call, and we just keep hoping for some news. And yesterday we're filming this on a Tuesday, and this week's call was on a Monday, and yesterday they said, it still looks good. It's just a matter of when. And unfortunately, the longer this gets delayed in an election year, the less likely it is. So obviously, we'll keep doing our part and keeping the pressure on and keeping the communication active with DC. But Kyle, and thinking about how the firm's grown over the years, obviously, now we do hundreds of studies annually. I think there's some myths still about the credit. I go back to when I got in this business back in the mid-2000s after public accounting. You got in the business, obviously, just shortly thereafter. There's been a lot of myths that we've had to bust through, and some that we still have to bust through. Inclusion of supply costs, how to, dynamics of funded research, what's truly qualified in terms of technical risk versus business risk. I think with the coming, could you kind of give our audience an update in terms of what we see coming down for the 24 year? And, thus far it's been, if you look back over the years, we relied on documentation and estimates and made sure we had nexus. Then a couple of years ago, that came out and required memos that were attached to amended returns. In 24 could be another big year of change for companies claiming the R&D credit. Can you kind of walk everybody through that?
Yeah, for sure. So the instructions for Federal Form 6765, which is the tax form that taxpayers can claim the research credit on is changing, and it's changing quite a bit. It's a much more expansive, intrusive process that's going to be required to fill that form out, to complete that form. And taxpayers are going to have to really take a closer look at what their business components are, what their projects are, and provide information about what those projects entailed, how they meet the qualifications of the credit, what expenses were dedicated to those business components, and then also what changed with their business from one year to the next. And looking a little bit into what the IRS is really trying to look at, and they're trying to pin taxpayers into specific business components, specific projects, which presumably would make an examination easier for them. But that form has changed. I think maybe there's good and bad about that. It's good because I think it will provide a guideline for taxpayers on what information they need, but it's also a challenge because there's going to be a lot more record keeping time and required from taxpayers in order to meet all the criteria that's on those instructions. Those instructions are similar to the memo statements that are required for amended returns now due to the specificity requirement. But yeah, it's definitely going to be a change, and it's going to change how taxpayers track everything and what kind of documentation they maintain.
As I look at this new guidance or these new compliance requirements coming out, Kyle, I think about our clients, because it used to be, given the fact that the federal credit's 6 to 8% of the allocated spend, all right, and there's opportunity costs that they incur in tracking this data, and there's engagement fees associated with making sure they're having their activities reviewed to calculate the credit every year. This guidance, one thing I look at it just requires more people or companies to be more mindful of their spend, and is it worth it to process the credit? I mean, if you're looking at it going, used to be the old adage was, you see a couple $100,000, it makes sense to pursue the credit. That may be more now. And that's the thing that I look at that compliance angle, and people overlook that. But the reason I bring this up, Kyle, is that IRS is still looking at this credit. And I know ERTC gets a lot of attention right now by the IRS, but the R&D credit's still out there, and it's still a scrutinized area of tax law. For people thinking about the R&D credit or CPAs that are using firms, whether McGuire, Sponsel, or somebody else, can you kind of help us understand what the IRS is looking at right now when we have our client experience an examination?
Yeah, the recent trend with the IRS has really been a focus on that business component. And that's a test, a 41 test that was for years, decades, never really paid attention to in examination. And the IRS has really pressed that hard over the past couple of years. They really want to know, what is that qualified project? They want to know, what is the product? What is the process? What's the technique, the innovation? And they want the taxpayer to commit to those projects, to those business components, and defining those and describing those. And not only that, but forcing them to quantify their expenses within those business component buckets, and really forcing a very systematic accounting system, which a lot of small and medium-sized businesses just don't operate that way. So it's a challenge. It's a challenge for those small businesses that you have business owners and engineering managers and engineers that really wear multiple hats. They're helping with production. They're helping with design. Their time is spent all over the place. So for them to be forced into that business component, very departmental type of tracking, it's tough. But that has been probably the biggest new area that we've seen with the IRS. Funded research continues to be an issue. You hear everyone's heard the 4-part test for qualifying for the credit. There's really 1,000 different ways to deny a research credit claim. If it's not one thing, it's something else. If it's not funded research, it's the adaptation exclusion. If it's not the adaptation exclusion, it's your fixed base period, your fixed base percentage. So there's always something that the IRS is targeting, and I would say that right now that business component test, it's incredibly important for taxpayers to focus on that, define what your business components are, and stick to it.
You know, a lot of emphasis is put on the federal credit, and for good reason. It obviously applies to all states. There's a lot of court case law out there to help practitioners like us know how to advise our clients and build a study. But can we also talk about the implications of state credits? You know, obviously we're in the Indianapolis office today filming, and Indiana has a very lucrative credit. But obviously years ago they came out and started scrutinizing it very heavily and kind of learning on the fly on even how to audit this. Obviously California has had a reputation for years of being very challenging on amended returns. Can you kind of walk us through how the states are looking at R&D tax credits these days?
Yeah, and most states now do have a state credit, and it doesn't always mimic the federal credit, but 4 out of 5 or so states do have a state credit. Some of them more lucrative than others, Indiana being one of the more lucrative ones. But what we saw maybe 8 or 9 years ago was a group of states, particularly in the Midwest, they got together and they started working with the IRS, and they really started attacking those state research credits, and they started working together. Some of that was actually a good thing. There was a lot of abuse of state credits, and I think there probably still is. So their action, I think, was probably warranted. They may have taken it a little bit too seriously and just had a hard line stance of disallow no matter what. I think we're back on level playing ground with most states, and they're more familiar with the credit. They're more familiar with the requirements of the credit, and their taxpayers can claim the credit with a little bit more confidence at the state level for most states. There are some states that have, I think, better policies towards the credit, better systems. I think of Pennsylvania that limits the credit, and they'll prorate the credit based on how many applications they receive for both small and large businesses.
And that's a year in arrears. You calculate the credits, and then the year you calculated the following year is when you actually receive the credit.
Yep. So different states, I think, have handled things differently and better in many ways.
Kyle, on the state credit front, the one thing I always think about is all the different variations states have. Obviously, we had MPT years ago in Michigan, and I remember when Wisconsin had their super credit. Remember that when we were doing it was just this exorbitant credit on top of regular credit. So it's been interesting to see the evolution of these states and how they some of them changed the program completely, some changed the scrutiny. Obviously, it varies from state to state.
It's one of those things, TJ, that I think taxpayers, CPAs really need to pay close attention to, because there are a lot of states that are changing their rules annually, and you really never know what different states are going to come out with. For example, Iowa has different industries that they prohibit from claiming the credit, and it's not that obvious that that's a policy they have.
And some states scrutinize certain industries more. I think we saw that with Texas, I believe, is that they came after certain industries a lot more. They didn't exclude them; they just scrutinized them more.
Yeah, Texas with software, Indiana with HVAC, specialty contractors. It seems like every state has target, and that target's constantly changing. So it's just one of those things that we're always trying to pay very close attention to.
And Kyle, in our closing moments of this episode, I think one thing that you and I have shared over the years is that, we talk to a lot of clients, and we talk to clients that have been clients for years. We talk about to companies that have used other providers, and now they're coming to McGuire Sponsel. We talked about companies that have never taken the credit before, and they come to us the first time. Would you why don't you give us a couple of the biggest myths that you see about the R&D tax credit?
Yeah, I think one of the biggest areas that when we talk to new clients or clients that have had a R&D study conducted by a different provider, is supply costs. We see a lot of overstated supply costs, and it makes it a challenge due to the incremental nature of the credit. It makes it a challenge for them to pursue the credit moving forward prospectively. Their base period, that 3-year base period under the ASC method, prohibits them from really being able to benefit from the credit. We see a lot of kind of extreme examples. Nothing I do qualifies, and everything I do qualifies.
And that can happen in the same meeting, by the way.
Yes. So we, everything from your general dentist that believes they have a 7-figure credit to a acoustical engineering firm with 15 PhDs on staff that is convinced they don't qualify. So I think those extremes those are the areas that we're constantly battling.
Well, Kyle, in our last couple of minutes here, I have 2 more questions for you. All right. Number 1, what is the weirdest, most unique client situation that you've been a part of over the past 16 years?
We had a client hire us back in March of 2008, our first project, and we sat down to interview the president, and you're not going to want to share this. This is terrible. He just stared at us for half an hour straight and didn't say anything. That's the first thing that sticks out.
The most ironic part about that, Kyle, is he avoided us for the next couple of years, then came back in the absolute opposite. So in March of 2008, nothing he did qualified, and then he had this epiphany that he thought everything that in his entire company was qualified research. Yeah. So we are the ones that suddenly had to pull back on him. And that kind of speaks sometimes to the situation that we're in our specialty, is that we're meeting with a company, we're saying R&D, whether it's to a machine shop or an architectural firm or a mechanical contractor, and they think that's white lab coats, beakers, and test tubes. And then once they understand the credit, once they hear how that intersects with their business operations, then you have this complete Jekyll and Hyde moment where they switch to the other side, and we suddenly have the reins pulling them back, going, wait a minute, not everything you do qualifies Mr. and Ms. Client.
Yeah, and that is one of the areas one of the issues that we deal with daily. Is educating not just the taxpayer, not just the client, but the CPA on what, not what you think is R&D, but what is R&D as the IRS defines it, and making sure that we have their ears and they're hearing that. And we're constantly re-educating our CPAs and constantly re-educating our clients on what does and does not qualify. Looking at maybe one of the funniest or strangest experiences, back to your question about that we experienced on site with a client. We had a project for a custom conveying company up in the Cleveland area. This is probably 15 years ago, and we had an interviewee who was an engineer for the company, and his wife was an interior decorator, and one of her clients was LeBron James. Well, it took me 10 seconds to tell you that, but it took this guy 4 hours to tell us that his wife was LeBron James' interior decorator. It's just one of those interviews that I'll never forget. It took up the entire afternoon, and we couldn't get him out of the office.
Now, I'm a little disappointed, though, okay, that you didn't describe the most awkward site visit. And we're not going to name names, but it was in California. We flew out. I missed the flight. You got there first. She called me Mr. Taxman during the entire time. She required us to stay in her guest house. And then she took us in, and she was a woman that wasn't born in this country, and she took us to an ethnic restaurant, and would not allow us to know what. She didn't tell us what we were eating. She just ordered for us, and they brought the food on our plate. That, to me, was probably the most unique client experience, being called Mr. Taxman to everybody in her company, being told I had to stay in her guest house, and going to restaurants that we had no idea what we were going to eat.
Yeah, that was a super cool client, super cool technology, and definitely one that I'll never forget.
I will never forget. I will also never forget, because that was the day that we paid off all of our startup capital at McGuire Sponsel.
Right.
So right. that was a very memorable trip. Kyle, I'm thinking of how we go to market at McGuire Sponsel, through this relationship of these 500 local and regional CPA firms that look to us. I'm putting myself in the shoes of a CPA that's listening to us for the first time, or have heard of us and have just got to know that we have this strong capability with R&D tax credits. They have a client, they've never discussed the R&D credit before, even though their client's probably been marketed to before. How do we help that CPA feel comfortable that they're not putting the relationship with their client in peril by bringing this idea, this concept to the client 40 years after 40 years of being in the tax code?
Yeah, I think the first and foremost, we just are very good at educating those clients and keeping the CPA in the loop on what does and does not qualify. And what really matters is how the IRS defines qualified research, not how an individual taxpayer defines it. So it's something that we do every day, and I think we're very, very good at it. And it is a very much a no pressure, educational, painless process for the CPA and for the client. And we're always making sure we're following the CPA's lead. So if they express that concern to us, we're very, very accommodating to those concerns and working I think in a very professional manner with those clients that have never claimed the credit before.
And everything we do is complementary to the CPA. I think we're always going to respect that client relationship and that CPA client relationship. And as I told a CPA one time leaving a meeting in which the CPA wasn't the one that brought the idea to the client, another firm did, and the client called the CPA, and so they brought us in. And I remember walking out of the meeting, and the CPA looks at his colleague who was there as well, and three of us are walking in our vehicles, and he goes, "Boy, that was awkward." And I said it would have only been more awkward if another CPA had then brought that to your client's attention. Unfortunately, we were able to control the situation. We were able to answer the questions and make the client feel comfortable on what's going on. Kyle, thank you for joining me today. Thank you for being part of today's podcast. Reminder, everyone, to subscribe to at Let's Talk Tax Podcast channel on YouTube to be notified and receive all new episodes. In addition, we invite you to visit us online at McGuireSponsel.com to see today's show notes, technical resources, and links to more about today's content. Take care.